Welcome back to our eInvoicing Express series. With tax reporting being one of the big drivers behind eInvoicing, today we'll explore some common VAT scenarios faced by taxpayers that can have less than straightforward implications when it comes to eInvoicing. Join us as we explore these challenges and the critical steps you may need to take to ensure these transactions are reported correctly. Let's begin by understanding the key categories of tax invoices: compliant and correct. A compliant tax invoice is one that meets all the prescribed requirements, such as including the buyer's and seller's VAT registration numbers, a unique tax invoice number, the date of issuance, a clear description of goods or services, rate of tax for each supply, and the total payable amount in AED. Along with being compliant, tax invoices must also be accurate, meaning the correct tax treatment is applied. This could revolve around proper classification of goods or services, applying appropriate tax rates, and ensuring zero rating correctly. Let's now look at some scenarios in which raising compliant and correct tax invoices could be challenging, and the respective considerations from an e-invoicing perspective. Exports. Exports of goods and services are zero-rated if they meet the conditions specified in the VAT regulations. However, businesses usually face the following challenges: identifying and recording buyers' information, distinguishing temporary versus permanent exports, tracking export documents for VAT claims, confirming exports within 90 days, and ensuring compliance for returnable sales. To address these challenges, businesses should consider the following when generating an export invoice: accurately record buyers' details with ID numbers, automate classification of exports, track exports and maintain documents for zero rating, document export and reimport for return sales, and track return periods and VAT adjustments. Milestone-based tax invoices. Multiple tax invoices are issued for staged payments, which are particularly common in our clients in construction and real estate projects. These are subject to VAT, depending on the nature and classification of the real estate projects, with the tax due being based on payment milestones. Businesses usually face challenges in tracking payment milestones and charge VAT per supply date, and maintaining visibility of all tax invoices for each project. When dealing with such cases, one should consider checking your e-invoicing software supports tracking payment milestones with VAT timelines, and adding custom fields such as project ID and master contract number for better invoice tracking. Retention. Retention is typically common in large construction projects or EPC contracts. In such situations, VAT is charged only on the value net of the retained amount, that is, the value received up front, excluding amounts withheld for retention. We have seen businesses often getting this wrong and misreflecting the retention clauses in invoices or contracts. To address this, such businesses may consider automating VAT calculations for retention amounts, ensuring VAT-compliant retention clauses in contracts, and adding custom fields to tax invoices for better tracking. Intercompany transactions. Generally, when a group has multiple entities within its structure, it is common for some entities to incur expenses on behalf of other group entities. When these expenses are subsequently recharged, it is crucial to determine whether the recharge qualifies as a reimbursement or a disbursement. This distinction is important because reimbursements are taxable under VAT, whereas disbursements fall outside the scope of VAT. We have seen businesses often struggle in identifying the actual recipient of the service, determining under whose name the tax invoice is addressed, and understanding the contractual obligations. Without evaluating these factors, it cannot be determined whether the transaction qualifies as a reimbursement or a disbursement. To stay compliant, businesses should document intercompany transactions to distinguish reimbursement versus disbursement, and establish processes to ensure systematic e-invoice generation for tracking. Transactions with multiple tax rates. VAT on goods and services may fall under standard rated, zero rated, or exempt categories. When multiple VAT rates apply, invoices must segregate values clearly. Businesses having such transactions should evaluate training invoice preparers to identify goods or services with varying VAT treatments, and ensuring e-invoicing software supports multi-rate VAT calculations, noting limitations and workarounds. That wraps up today's edition of the eInvoicing Express series, looking at some of the trickier areas of VAT that have reporting complexities in an e-invoicing context. By implementing the right processes and leveraging the right software solution, businesses can simplify even the most complex VAT scenarios. Stay tuned for Part 2 covering other challenges from an e-invoicing perspective in the UAE. Special thanks to Signet for their contribution to this project. Thank you for watching.